Riding the central bank's interest rate pivot. Let's talk about different ways that you may want to invest with interest rates being lower. As you may or may know, Fed Chairman Jerome Powell signaled that rates might be dropping in 2024, depending on how holding rates steady toward the end of 2023 and early 2024, how it's going to affect everyone's favorite economic phenomenon, inflation. So, what are good investments if that holds true? That is, that the rates go lower. Let's talk about it. When the Federal Reserve lowers interest rates, it oftentimes has an impact on various sectors of financial markets. Some perform better, some perform worse. Let's take a look at some of the investment vehicles that tend to perform well in low interest rate environments. Stocks, for example. Lower interest rates can be favorable for stocks for a couple different reasons. Namely, companies may find it easier and more cost effective to borrow money for expansion or to finance share buybacks. Another reason that stocks might do better is that lower interest rates can make stocks more attractive compared to fixed income investments like bonds. That said, though, certain types of stocks also do better as well, such as growth-oriented stocks. Growth-oriented sectors such as technology and healthcare, they may benefit from lower interest rates as investors tend to seek higher returns than what fixed income investments can offer. Dividend stocks can do well too. Companies that pay dividends can become more attractive to people seeking income when interest rates are low. Dividend paying stocks may provide a relatively higher yield compared to bonds because of this phenomenon. Real estate also tends to do well in low interest rate environments. For example, real estate investment trusts. Because lower interest rates can lead to lower mortgage rates, real estate investments, including REITs, tend to be more attractive. REITs have been known to pay dividends and can be an income generating asset. And they've also been known to be very competitive with the S&P 500 and other asset classes in terms of returns for investors. But it's not just in the stock market. Lower interest rates can also help home builders. So if you're thinking about getting into real estate construction or one of those real estate niches, now might be the time to consider it. Lower interest rates can stimulate demand for housing, benefiting home builders and related industries around home builders like construction, lumber, etc. Fixed income is not necessarily left out of the equation as well, as bonds might benefit from lower interest rates as well. As interest rates decline, the value of existing bonds with higher interest rates, with higher coupon rates, tend to increase. Corporate bonds, especially those with higher credit ratings, may see increased demand. And then there are treasury bonds. While the yields on treasury bonds may decrease with lower interest rates, their prices tend to rise, providing capital appreciation, kind of like when a stock's value rises. Then there's precious metals. Gold and silver, for example. Because gold and silver are often seen as hedges against inflation and currency devaluation, a lower interest rate environment where inflation may kick in high gear again, this attracts certain investors of a certain mindset. Lower interest rates can lead investors to search for higher yields, making high yield or junk bonds more appealing. Just like stocks, junk bonds come with higher risk due to the lower credit quality of the issuers. So as you can see, there are multiple investment vehicles that could benefit from a lower interest rate environment. That said, though, there are some risks associated with lower interest rates. I have a video on that topic that should be popping up right now that I think you want to check out. And remember, that a goal without a plan is a wish. A goal with a plan and no action is a wish list. This is Derek West for Finance Squared. I'll catch you guys in the next video. Take it easy. Peace.